Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Ty?
Good morning, Dean. I'm doing well. How about yourself?
Great, thank you. Today we're going to be talking about life insurance. We want to talk about life insurance to see if it's an important part of your retirement planning or not. And with us today, we have a special guest. We have Kevin Klug. He is my business partner. He is also the founder and co-owner of Secure Retirement Solutions, where Tyler and I also work. So Kevin's going to be helping us out talking about the topic of life insurance. And a little background on Kevin. What Kevin does is he puts together retirement plans for our clients, puts together income plans for them, and he also takes care of the life insurance needs for all of our clients and those people who want to work with us. Kevin, how are you this morning?
Good, Dean. Good, Ty. Thanks for having me.
You bet. You bet. Okay, let's talk about life insurance. Let's get started right away. The first thing is, before we can determine if it's an important part of your retirement plan, let's talk about the types of life insurance. People typically, when they come through our doors and we sit down and we talk to them through the fact-finding session or that meeting, they'll just refer to, I have a life insurance policy. But we have found out that there are a number of types of insurance, and we're going to go through the three main ones first. We're going to talk about term, whole life, and index universal life. So, Kevin, just give us a quick scenario here. What is term versus whole life versus indexed?
Term is exactly what it says. It's designed to cover you for a specific term of time, 5, 10, 15, 20, as much as 30 years. Often you'll time it out to where maybe your mortgage ends or your children are adults and out of school, retirement, things like that can help protect you for a certain term of time. They're designed to run out at a specific term, and typically they'll price you out of it. The premiums will get up so high that where you walk away from it. Permanent whole life is something it's been around for years. It's designed to pay and cover you for your whole life. Often, depends on how long you took it out, how many years ago. It might run out potentially at age 95 or 100. Now, a lot of companies are running policies of life expectancy to 120 to 121 years of age, so it doesn't run out. And finally, number 3 would be indexed universal life. This is something that's relatively new in the last few years, indexed life, where you index. The internal component of the cash value is indexing, let's say, the S&P 500, and that's something that can give you some larger gains to build cash value, increase death benefits, and we'll talk more about it here in a few minutes, but many more features that are with that will grow old with you and continue through your entire life.
Okay, so when we see these clients come in and we talk about insurance, a lot of people feel they don't need it as they get older. One of the things that I've heard from clients in the past is, why would I need life insurance? Fortunately, I've taken care of myself. I have enough investments and retirement plans. But I think they're really missing the point, and that is life insurance can be utilized in a number of different ways that we'll be talking about, okay? But first of all, who needs life insurance? I mean, when people come in, do you look at them? Do you have a question that you ask them? I mean, what determines who needs life insurance?
Well, Dean and Tyler, as you guys know, we work with all different ranges of clients. Tyler, younger, you and I, the retirees. So we look at their specific situation and start with the younger clientele. If you have dependents, if you have children, you're married, and you have responsibilities, you want to protect your family, and we do that as well. We'll talk about that, but it's important. People with dependents, people are married couples, children. You might even be single and have debt. You want to protect that, your family members, any beneficiaries and things like that. So the younger you are, the healthier you are, the less it costs. So that's when you tend to look at it.
Okay. And one other thing, too, is, I will bring up to clients that I also like to see life insurance in place to protect their investments. And they'll say, well, what do you mean by protecting my investments? How does life insurance protect that? It's supposed to protect me. Well, what happens here is if you have, for instance, a married couple and a spouse passes away or is sick for a significant period of time, many times the surviving healthy spouse has to utilize a lot of retirement income or investments to pay for that spouse that's ill and then ultimately passes away. So what happens is then you lose a spouse, so you lose an income that could be in the form of either a pension or it could be Social Security. One of the Social Security benefits are going to go away. And you've also brought down your retirement plan substantially. So I like to see it as a basic element of a retirement plan to offset some of those costs.
And keep in mind, Dean, that in life insurance death benefit is tax-free. You get that death benefit. You can utilize that for income. It's just another pool of money that's added to your estate, and it wasn't taxed. So it's a huge advantage.
Okay, and both of us have children. I mean, Tyler's here on this interview with us, but it's something that, as a parent, you never want to think about, but we do bring it up from a life insurance standpoint. If you have a child who you are responsible for co-signing loans and they incur a lot of debt in school, it is best to be responsible and make sure that child has a life insurance policy. Now, at their age, if you're college aged, typically you can get a term policy, which will suffice. A term policy will take care of those debts if they incur those during their school ages. The other thing, too, is it's going to be very cheap, correct? I mean, their policy should be significantly cheaper than what I would pay at 56 years old.
Definitely. A young individual or even married couple, I did a quote a few weeks ago for someone slightly older than that, 30-year-old couple, $500,000 non-tobacco, preferred non-tobacco, term, 20-year term policy. It was between $22 and $25 each per month. I mean, everybody pays $100, $120 for their cell phone bill. Life insurance for any age, if it's needed, needs to be part of your daily budget. You spend $100 and some on a phone, you go out. It's the cost of a dinner out. You can cover and protect your family.
Okay, so a college student who incurs debt, get a policy on them. I've heard from some clients, well, I really don't need to worry about that because that's their debt, even if I co-sign. Is that true?
No. I mean, if you co-sign and that child defaults or grandchild defaults and you've taken on that debt, they can garnish your Social Security in the future. That never goes away with bankruptcy. You can't run from it.
Okay. Another thing, too, that comes to mind is pensions. Of course, we see fewer and fewer pensions, but we do have people that come in and we go through creating a complimentary retirement analyzer. Anybody that comes through our door, we will put together a retirement plan for them. Part of the reason is we need to know what their financials look like, too, before we can make a recommendation. But if a pension comes up, we'll have some people come in and say, well, you know what? We really want to retire. I have a good pension that I can trigger. Trigger meaning you get the payment started as fixed income, and you have selection options. So as an example, if somebody is married, they can choose a 100% joint payout, meaning you receive the pension, and if you were to pass away, your spouse would then continue that pension. Or you have some options of taking maybe a 50% joint payout, which means you're going to get more per month, but if you pass away, your spouse is only going to get 50% of that benefit. So, Kevin, you've done the same thing here, too, and that is many times we will try to make sure that we have life insurance policies in place to help offset that pension reduction if that spouse passes away. The only problem with it is most of the time when we talk to people who have a pension option, they could be past that sweet spot in their life where they can still get a policy. For instance, somebody can come in and they're 65, 66 years old, and they say, well, we need to have a policy put in place to offset the loss of my pension if I pass away. Unfortunately, they're at the age where it's either going to be very expensive to get that premium, or unfortunately, they're insurable.
Yeah, we see that often. I use a term for years. You get a life insurance when you don't need it, so you have it when you do, and that's pre-planning. That's planning ahead. You and I are I'm in my low 50s, mid 50s. You are. We have overlapping policies. We have term policies that'll carry till our kids or my kids are in college. But I have a permanent policy right now that's going to carry on indefinitely. But speaking of pensions, yeah, you have to be very careful when you do select that pension option, and you have to protect that spouse. And if you're taking a full life only or a joint life with 50%, you have to look, and that's what that retirement analyzer that we do every client that we meet with every 6 months, at least once a year, we're updating this. We can look ahead. We can look if you're 3, 4, 5 years, 6, 7, 8, 10 years out of retirement. We can look to see what insurance you need now to protect your family and in the future, specifically with pensions.
Okay, folks, if you're just tuning in, this is Dean Listle. I'm here with Tyler Listle. We're here with a special guest, Kevin Klug. We're all with Secure Retirement Solutions. We're located on Allied Street in Green Bay. If there's something here that we're talking about that you would like to get more information, give us a buzz at 920-347-9888, or you can go to our website at srsplans.com. Okay, let's talk about who doesn't need life insurance. Are there certain categories of people who don't need life insurance?
Yeah, we look at single individuals. For example, Ty, we talked earlier today, and you don't have a lot of debt or any debt. You're not married. You don't have children. So you might have some through work, which might be sufficient. Or maybe you're older in your life, and you're self-insured. You've got assets built up. You don't have any debt. You're getting ready to retire, and you have the proper income. You have that pension that's protecting that spouse. Very likely don't need it as well. Maybe a final expense policy or some prepaid funeral trust or something like that.
Good points there, Kevin and Dean. And exactly what you said there, Kevin. I know myself, right now, I'm probably currently a person that doesn't need life insurance. I don't have a policy. And reason being is that I'm single right now. I don't have any kids, and I paid off all my school loans, don't have any debt right now either. So with that said, I don't have one right now. But as soon as I do get married, have kids while I'm young, I'm definitely going to get one. And that's what it's important that we reiterate that to our clients. And I see a lot of younger clients who come in, and they may be just married. They might have younger children, 1, 2, 3 years old, and here they don't have any life insurance, and they're not even thinking about getting life insurance. And to me, those are the ones that need it the most. That as soon as they're married, as soon as you have kids, you're going to want that life insurance. And while you're young, you're going to have great rates, and your insurability will be then at its peak. So those are the ones, again, that it's very important to get life insurance on. But again, someone like me, who right now single, no debt, not married, no kids, probably doesn't need it at this point.
Okay, good point, Tyler. Okay, what about those people who bring in their statements, and it's a policy that they have with their employer? Now, it's a great feature. It's a wonderful opportunity to have life insurance through your employer, so we like that. But what are some of the things we need to think about there, Kevin, when somebody comes in with a policy from their their employer?
Well, through your employer, you're right. That's a huge opportunity and benefit. Take advantage of it, because typically it's a group policy that's very cost effective for you. But often today we see a lot of clients, young and old alike, that are moving jobs. My grandfather stayed at the same job for 40 years. You don't see that anymore. These policies typically aren't portable, so you're starting over every time. Some might have 2 times annual salary, some 3, 4. Get your own standalone policy that maybe can jointly go with that to carry and keep yourself and have enough insurance. So a simple term policy that's portable, that goes with you at the proper age, is going to give you the protection you need.
Okay, is there a rule of thumb that you look at when you recommend how much insurance somebody should carry? I mean, I have heard 10 times salary, but there's got to be more to it than that. What determines how much you should really get? Because again, that's a very common question. People come in, we say you do need insurance in place here for whatever reason, but then we have to come up with how much.
Yeah, I mean, there are many calculators out there. We have one at srsplans.com for factoring in all the different things, but the things that you put into this calculator would be consideration of college debt and expenses, children for future, mortgage payment, how much debt you have there, car loans, credit card debt, your age, how old are you? So if you really want to get specific and don't want to just ballpark it with a 10 times salary or whatever the number is, we have calculators that we can plug that in at your current age to help you determine that you're properly insured, and it's okay to be slightly overinsured because your income's going to go up in the future, expenses, inflation, and things like that. So it's really sitting down with a life insurance specialist that can help you determine how much you need to protect your family, because everybody covers their homeowners for insurance, their car and stuff. We don't know if we're ever going to have a fire that's going to devastate our house, hopefully not, or an accident that totals your car out, but we're all going to die. So, that's inevitable. So you've got to protect your family. We don't know when that time's coming.
Okay. And if you're going to make a mistake in determining how much insurance you should have, we recommend it be get more than less.
More than less, yes.
More than less, especially if you're younger and the premiums are very cheap and affordable. Okay, it seems to be whole life policies were referred to quite often, right up till about 10 or 15 years ago, and now we hear more about indexed universal life. Okay, we hear more about it. We hear about the opportunities to be able to borrow from it and so on. Kevin, just give us the components of that, because again, a lot of our clients come in. A lot of people who are inquiring whether they want to work with us or not will come in and ask that question. Really, what is that product?
Indexed universal life is kind of a spin-off or a hybrid of universal life. And the component that's really important here is indexing. It's linked to the S&P. It's linked to different indices, meaning your cash values growth versus just a fixed rate. And it gives us potential to earn a higher rate of return in positive markets like we've seen over the last several years. And so it allows a lot more flexibility. Universal, you can stop premium payments in the future. You can have a paid-up policy. Or I use the example that I use my own personal experience in policy, that I have an indexed universal life I started about 4 or 5 years ago. And you typically want to give these about 15 years to kind of stew and percolate. But what I'm able to do for 3 phases. First phase, ultimately I have term insurance, but this is overlapped with my permanent. And I am protecting my family, my 2 children, and my wife, that if something happens to me, there's enough death benefit tax-free that will cover my children and family. My second phase is I'm a believer, and we see it everywhere, and we hear it everywhere, that Social Security benefits in the future, estimated starting in 2034, will have a reduction of possibly 25%. So I'm planning ahead with my retirement analyzer. I do it myself, and I'm looking, if I have a 25% reduction in Social Security, where am I going to go to make that up? I can take out a loan from my life insurance cash value, and that charges me a percentage, but it's also making a percentage to offset that. I'm not taking a withdrawal. I'm taking a loan, which is tax-free. I have other assets, but this is a way that I can tap into this as well. Third phase is going to be what we called earlier that living benefit. So in this time in the future, later on, if I can't perform 2 activities of the 6 daily living, I can trigger this policy and I can accelerate it and take a tax-free benefit over a period of time to offset the costs of long-term care expenses. So I have one plan that covers multiple phases of my life. It's like a bundle pack. It's a complete bundle that's going to help me protect myself and my family. Okay,
you bring up a very critical topic, and that's long-term care. We are in the profession to help people in their retirement. We look at debt reduction. We look at establishing income in retirement. But when it comes to long-term care, we would love to see everybody have a long-term care policy, but that's not the case, is it? I mean, we really don't. Yeah. And what we do, though, is, as Kevin just touched on here, there are now life insurance policies that help you with some of your long-term care needs. And actually, it's something that I use in my own retirement plan. I have a term policy that is going to term out when I'm 65 years old. Well, now in my mid-50s, I decided I'm going to get another policy. So there's going to be some overlap, but I wanted to do it before the premiums got too high or I become uninsurable if I have a health issue. So I have a policy in place, and it's mainly not necessarily for the death benefit for my spouse, though it will help her out substantially if I pass away. But it's because I wanted to have something to address long-term care needs. So Kevin's talking about those living benefits or accelerated death benefits. Here's an example. I have a $250,000 death benefit, but within my policy, for no additional cost, they have the accelerated death benefits. If I have a terminal illness, if I have chronic care needs, or I go into a nursing home, the death benefit will pay out while I'm living approximately $175,000 of that $250,000 death benefit. So that is going to allow my wife not to have to utilize our retirement funds to take care of my needs. And when I do pass away, yes, less of that death benefit's going to go to her. It's going to be the difference between the $175 that's been paid out and the $250 face value. But it is going to keep her standard of living even and not have to deplete our funds to take care of me if I'm critically ill.
And that's a good point, Dean. And I always like to tell people, my clients, life insurance in today, like especially with the indexed life, it's not the life insurance your grandparents had years ago or even your parents. It's evolved into so much more. And it's important to sit down with a specialist that can help you determine what are your needs. Because, I've heard stories over the years where people say, well, yeah, I was told that my life insurance was going to be able to fund my retirement. It has to be set up properly. It has to be funded properly. And that's where we sit down with clients, say, okay, what's the purpose of it? Do you want it just as a death benefit? We can do that. Do you want it to supplement, or there's a multiple features that it has to be funded right from day one, and we help our clients determine what it's used for and how to fund it properly.
Good point. Ty, are you missing anything on the long-term care needs?
No, I think we covered everything really, really good there. Just again to reiterate to the listeners that, like you said, Kevin, in today's world, life insurance is different. It's not your parents, not your grandparents' life insurance, because a lot of times, historically, when you think of life insurance, you think of the death benefit. Now, you get the death benefit plus the living benefits, whether it be tax-free income or the accelerated death benefit, where you can use a portion of that when you're still living before you pass away. So, again, I think you guys covered a lot of good points there.
Okay. Let's talk about what happens when people turn 70 and a half. In previous shows, we talked about required minimum distributions have to come out of your qualified accounts. Qualified meaning traditional IRA or a 401k or any other employer-sponsored plan. So those required minimum distributions are required. They come out. If you're not planning for them properly, it can be a bit of a surprise. And in a previous show, we talked about what to do with them. You can invest that money if you'd like. However, you really don't have a lot of time on your side. You're 70 and a half years old, so you're not going to get substantial compounding interest. And if you do have something that has substantial gains, typically you're probably going beyond your risk tolerance. Second thing is learn to spend it, okay? We tell people you worked all your life, you might as well learn to spend it. And believe it or not, this is very hard for some people to do. You can gift it, you can give it away, which is a wonderful thing. Or what we're seeing more and more people do now is with the amount of money they put into a life insurance policy, they can compound that, 10 times or more for their loved ones. They can create a benefit, a legacy for their loved ones. Kevin, how does that typically work, and what do you utilize there to take RMDs and turn that into a legacy for your heirs?
Once again, Dean, I'm going to turn back to the retirement analyzer that we use. We can plug in all their information, and even prior to becoming age 70 and a half, we're already looking at several years prior of how much their required minimum distributions are projected to be. And I had a client just a few months ago, Joan. She took out a policy. It was an indexed universal life, like we said. Her benefit was the death benefit. Of course, that's going to go to husband or daughter, but immediately right now she has that benefit as far as living benefits, that if she needs that, she can utilize it as well. She did a 10-year pay. She's 65. We know that she's going to have to take money out at 70 and a half, but she's younger. Rates were lower. She did a 10-year pay. So from 65 to 75, she's going to pay into this policy, $400,000 indexed universal life, and she'll have it paid up at age 75. And there's additional money left over to, like you said, either spend it, gift it, or reinvest it. She's able to do all three.
Okay. Kevin brought up just a couple minutes ago about possibly, keeping some money aside for final expenses. What people have to understand, too, with a number of policies out there, unfortunately, if you go through a Medicaid spend down, they might be open to that particular spend down. So there are situations where we have people who are setting up their retirement and their estate, and they'll say, well, I'd like to set aside this life insurance policy for final expenses. But really, if you're looking for final expenses and you don't want to have the children, pass the hat to get money, we typically would like to see a funeral trust put in place. We refer to it as an irrevocable funeral trust. That money is basically taken out of your possession. It's put into a trust in care of your name. So in most cases is not going to be spent down through a Medicaid process. So if you're looking for an insurance policy just for your final expenses, you may want to consider moving that into an irrevocable funeral trust.
Exactly. It can help protect some money, set it aside so that the money's there. And like you said, you don't have to pass a hat. We've heard of different clients that have come in and they've had to, gather money and try to help pay for funeral expenses. And if the money's there now, utilize this concept to protect it, set it aside, protect it immediately, and that money's always going to be there to pay the expenses.
Yeah, and guys, one thing real quick that I wanted to add, going back to the RMDs, your required minimum distributions. Like what Kevin said, we have the retirement analyzer where we can plug it in, and if a client comes in at 60 years old, they can look and see at 70 and a half what their projected RMD amounts are going to be annually per year. And we actually see where many clients will look and they'll actually cringe when they see the amount of money that they have to take out at 70 and a half years old. They may be used to living pretty frugally and want that money to stay there and grow over time. And when they say that they need to take, $30, $40, even $50,000 out per year at times, they don't like that very much, and that's where we recommend sitting down beforehand, like Kevin said, and that's where you want to fund the IUL policy, because you're going to have to take it regardless. If you don't, keep in mind that you're penalized 50% on what you should have taken. It's the stiffest and steepest IRS penalty out there. So again, it's just all about sitting down and planning with a professional.
And that's true, Ty. I mean, we're sitting down working with retirees, and they're able to leave a legacy. They're able to leave that legacy, but take money that they have to take out, pay the taxes on it, and you can leave that legacy and pass on to maybe children or even grandchildren and leave them money for college and things like that. So it's very powerful. We've seen clients already project to, take out a certain amount from their IRAs or our required minimum distributions, and they can literally replace that IRA as that's spent down with tax-free benefits. That's the equal amount that they started with as far as the account value.
Okay, as we're winding down, there's one other topic here I want to hit quickly, and that is business partners. People don't realize that life insurance can be utilized and put in place for a succession plan for businesses. What that does do is if a business partner were to pass away, that partner's spouse isn't left with all of the debt and having to deal with the business. Many times the money, the death benefit, is used to buy out that partner's shares who passes away. So we tell people, especially with small businesses, you could leave a tremendous burden on your family if you don't have a succession plan put in place. Many of those plans are funded with life insurance. Missing anything there, guys?
No, Dean, I think you covered that pretty well there. And just to kind of to summarize too here, what we talked about with Kevin is just the different types of life insurance. The term, the permanent, the indexed, universal life. And I think we all came to the agreement here that there's many people, almost all, need life insurance. Very few who don't. And then just the different types, Kevin explained how we can utilize the IUL, the Index Universal Life, in many different ways. And an important thing to keep in mind is the living benefits it provides in addition to the death benefit. Many people in today's day and age, they're concerned about the long-term care and things of that nature, and just how we can use the accelerated death benefit to provide a benefit while you're living, so your family and you can take care of your estate before you pass away. And then just the different ways that we can go about with some advanced planning, like using the funding an IUL through your RMDs and different things like that. So I think we touched on a lot of good things today here. Okay, that's all the time we have this week, guys. Thank you very much for the input, Kevin and Tyler. As always, thank you. And hope you enjoyed the show, and we'll see you again next week. Thank you, Kevin. Appreciate it. Thanks, guys. Take care. You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay.
Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.